Welcome to HyBiz News. You are watching Finance Business News. Now we have Vijay Karnam, personal finance expert, MFI and IDRF registered. Sir, what is mutual fund, SIP, STP, and SWP?
Sure, ma'am. Like last video, what we have discussed is the basics of mutual fund and why personal finance is important. And in this slot, in this video, we will understand what are the features is available in mutual funds. First thing is SIP, and second thing is SWP, and third thing is STP, and lump sum also will be there. So these are the modes in which amount is being sent to mutual fund and amount is getting back to your account. So for coming to SIP, so what we will do in SIP is like we will send a part of your income every month in mutual fund by using the mandate. So for suppose if a person wants to invest 500 rupees or 5000 rupees every month into mutual funds, he can create a mandate with the bank and the mutual fund AMC suggesting like every month 5th of every month 5000 should be deducted from my account and the same amount should be reflected in mutual funds, same amount should be invested in mutual fund. Like that he can use this feature and he can invest gradually into the mutual fund this thing. So that is an SIP, and subcategory of SIP is step up SIP also will be available. So where the amount which you are sending every month or every year, if you want to increase the percentage of money, like for suppose this year you are doing an SIP of 5000 and next year you want to increase 10% of 5000. So next year 5500 will be deducted from your account. So these are the various ways to send money into the mutual fund. That is the SIP thing. Coming to STP thing, STP means a systematic transfer plan. So where the money will be transferred across the mutual funds. For suppose if a client has a amount of 10 lakhs in one particular fund and he wants to transfer the capital from one fund to another fund. So in that mode we will use the STP mode, where the amount gradually will get exposed to the different types of mutual funds. So why we will use this STP is also question mark. So for suppose if a client has a big corpus and he don't want to take risk in exposing directly capital into equity markets, then what we will do is we will first park the money in debt fund or hybrid fund. From there it will be gradually exposed to equity mutual funds. So in that manner, risk will be reduced and returns are expected more than the traditional way. So in that way, STP will be used. Coming to the next topic, SWP, systematic withdrawal plan, where in this way we'll get back our money from the mutual fund gradually. For suppose if a person has a big corpus using the SIP and STP and he made a big corpus at the age of 50 or 60, and from then he wants monthly income from the mutual funds. So then he can opt for the SWP. SWP is systematic withdrawal plan. Using our calculations and using our strategies, if a person has a 1 CR corpus, every month he can get a 70,000 as a monthly income, and gradually over the period of 10 years and his capital also will get double. So these are the strategies which we will use in mutual funds to protect the capital, to grow the capital, and to secure the capital. Like these are the minimum what is the optimistic way and realistic way to secure a capital and grow your capital. These are the types. Coming to the next topic, lump sum. So when there is a lump sum, we generally don't prefer with the investors, because when there is a capital above 1 lakh, we always suggest them to use the STP mode so that their risk will be reduced. But many people mistakenly they will do the lump sums, and there are many chances to reduce their initial capital and low returns than the compared. These are the different types of features available in mutual fund.
Thank you, sir, coming for HyBiz TV and giving information. Thanks for watching. Keep watching HyBiz News.